Hello and welcome to Khaleej Times. My name is Ruben, taking a lead from a previous episode on psychology of trading and risk management. This is our part 2, and today we're going to be touching upon a little bit more on how we can manage or how to tackle risk management. If you haven't listened to the first part of our episode, I suggest that you do, and it is all lined up on khaleejtimes.com. This series is also powered by IG, which is a platform where you can trade in over 16,000 financial markets. And I have Mr. Monte Safeiddine, who was there, in a previous discussion as well when we spoke about the psychology of trading and investment. But today we're going to talk a little bit more about risk management in trading, Monte. So my first question is very basic so that everybody understands, what do you mean by risk management in trading?
Well, to put it really simply, last time we were talking a lot about psychology, about winning and about losing, about how our emotions play into the financial markets. When it comes to risk, it's really about quantifying that, putting a number on it, which I know we don't necessarily want to do, and it can get a bit dry sometimes, and we'll try not to go that route. But a lot of times you just got to put a number on it and say, okay, you know what? If you mess up, this is what you'll lose. If you don't limit your losses, this is what can happen. This is the exact number. And if you make money, this is what we're aiming for. So you're putting an actual number, a quantity on your mistakes. Yeah. You're putting an exact number on your gains and your losses. And I don't classify a loss as a mistake, by the way, because that's part of business, that's part of trading, that's part of investing. But I mean, when you make a mistake, as in you don't follow your discipline rules, this is what can happen if you let losses go, for example. So it's about putting numbers, quantifying it, of course. But of course, the underlying behind it remains psychological, remains things that we can relate to on a daily basis.
Yeah, but I think, isn't it, the easier route to take? I mean, or the better route to take when you actually quantify something or put a number to something, it's easy to kind of come around accepting or, dealing with a loss.
Yeah,
right?
we do. I mean, we do it when someone says something went up 10%, for example. You're putting a quantity. If you say it just went up, if you go, the stock went up, you go, yeah, it went up. Oh, okay. It went down. It tanked. It plummeted. You can put words that signify it's a big loss or a big gain. Like it surged, it powered higher. Yeah. But at the end of the day, if you really want to if at the end of the day, if you want to keep it calculating, which you kind of have to do, then we need to put it into numbers. So the stock price went up 10%, gold's price dropped by 1.2%, or Euro USD went up by 50 points, for example. So we're getting into specifics in terms of numbers, which we kind of need to do if we want to manage our risk, manage our rewards. Yeah.
Okay. Perfect. In this episode, we'll be touching on a lot of technical questions as well, but I will keep coming back to the psychology of trading, because everything I think starts from there. That is the initial point, right? Okay. So since we're talking about risk management, I want to know that are there any guidelines to follow? But before that, since you're an expert and you have a plethora of experience, I want to know and I'm sure that you invest. Or do you invest on a regular basis, or you trade on a regular basis? And if you do, what are the guidelines you would set for yourself? I mean, what are the things that you keep in mind when you're trading?
When it comes, in this case, within the context of risk management and within the context of the psychology that we've been discussing, it's about, before I'm going to go ahead and place a trade, I'm going to go ahead and look and say, okay, this is how much I want to put in. This is how much I want to trade in a certain asset class. So, for example, I want to trade the pound against the dollar, and I say, okay, you know what? This is how much I'm gonna utilize from the money that I have, this percentage. And then once I go into a position, this is how much I'm gonna make in numbers, and this is how much I'm willing to risk in terms of loss. So and it's very straightforward. And again, when you do it that way, when you look at that, you go, well, that sounds kind of dry, sounds kind of raw. That's kind of the point. I know it doesn't sound as exciting as going, all right, I'm going to go in and we're going to make money, which is how we all think, right? And then when it goes against us, we just lose and then we feel bad.
Yeah.
But that's
we all
kind
want
of
to be billionaires.
Exactly, and we all want to win. We all want to have that win. But unfortunately, that's not the way you have to go about it. You just have those numbers, and when I go in, and if it doesn't work out, tough. It's not a big deal. It stays the same. The air still feels the same way. I still look the same, and the food tastes the same as well. So your life goes on, and that's kind of how. Of course, I've gotten more numb to it, but of course in the very beginning, if we're talking, over about a decade ago, absolutely, I was sensitive. I didn't know, in the beginning, you're like, what's going on? And that's because I wasn't aware of the psychology behind it. But then once I understood the psychology behind it, and once I started to apply numbers to actually put it in a disciplined fashion, then it doesn't hurt me anymore. And it also, if I succeed, it doesn't also aid me that much. Like I don't feel that good if I make money, but I also don't feel bad if I lose money. So it becomes a more numb feeling, which is kind of where we should be moving when it comes to trading, and also outside of trading when it comes to business and things like that. We don't want to put numbers on that. If you have a business idea, a lot of times we just go, I want to open that business and I'm going to make money and I'm going to franchise it and whatever, all that stuff. But when you put numbers on it, and this is what risk management is, you're telling yourself, how much are you going to risk?
Can we put a percentage?
Well, let's put a number on it. So let's say you're opening up a business and you're saying, I'm going to put $10,000 on it. It's going to cost me, I'm going to risk $10,000. And the reward, for example, if it goes well, the reward could be, for example, $20,000. So now we've got a risk and we've got your reward. $20,000 if it goes well, $10,000 if it doesn't. That's what we call the risk reward ratio is 2 to 1. 20,000 divided by 10,000, it's 2 to 1. So you have a 2 to 1 ratio. It goes against you, you lose 1. Goes in your favor, you make 2. And when it comes to trading, you want to apply that kind of those kind of principles, where at the very least, your risk reward ratio should not be less than 1 to 1. You don't want to say, I'm risking, to put it into regular business numbers, you don't want to say I'm risking $50,000 to make $10,000. So if it works out, I made $10,000, yay. But if I lose and it doesn't work out, I've lost $50,000. So now your risk reward is way off balance. And the idea is you want to make it at least 2 to 1 when it comes to trading, 2 to 1 in favor of reward, where you're making more than you're losing, if not 1 to 1 at the very least. So that's the idea behind a risk reward ratio and behind keeping it 1 to 1 or 2 to 1 in terms of maintaining that consistency of profits.
Okay, since we're talking about the strategy to basically follow or design or these guidelines that you're discussing with us, what are the factors that go into designing a strategy, to manage risk? What would you say that the factors are, behind designing a strategy?
Risk reward, which we discussed. There's also size and the percentage in which you're going to allocate towards it. To think about this in layman's terms, if you're going to open that business and you're about to risk $10,000 to open it, that $10,000, is that a big chunk of your savings? Is it a big chunk of your money? If it's not that big of a chunk, you're not going to be as emotionally attached. But if it is a big amount, if it's everything, you are going to be emotional. You're by default, even if you try to break that emotional link, you are emotionally attached. Think of it kind of like, if you buy a really nice, you put all your money into a really nice car that you always wanted to buy. If you park it, at the mall and somebody dings it, opens their door and dings the car, you're going to feel really bad and everything because you've attached so much money and your emotion into that car. Whereas if it's just a car that you purchased and you like, but you haven't put much attachment into it, you haven't invested much into it, someone dings it, you go, what, it's part of life. I'm going to park at the mall. One of these days, someone's going to hit it. That's just the way it goes. And the same thing when it comes to a business, you go, okay, if that 10,000 isn't everything you have, you're thinking to yourself, okay, there's a chance that I could lose it. There's a chance that I could lose a portion of it. You're more mature about it. Whereas if it's everything you have, by default, even if you're trying to be mature about it, it's just more difficult. So what you're doing now is you're putting too much, and that's why not just managing your risk and reward, but managing your size. So you don't want to, if you have a trading account, for example, you don't want to put it all in to one position and say, okay, this is it. We're going, we're trading gold and we're going all in. And that's the wrong mentality. You don't want to do that. You want to allocate a very small amount, maybe maximum 10%.
So would you kind of, put a minimum number to it? I know it's very subjective depending
I would say,
on the kind of money you have.
It also depends on what you're trading as well, the volatility, because different asset classes move differently. I don't want to go into too much detail, but certain asset classes are going to have a lot more wild movements, and others are going to be very, very volatile and relatively range bound. It'll still trend, but not as much. And if it doesn't trend, it's not that volatile. Yeah, you can up it a bit. You can say, okay, I'm going to use 20% of my capital towards a trade. Of course, with CFDs, you do have with contract for differences, which is where you're trading the difference in price and not the underlying asset. There is of course leverage, so you're able to trade with a greater financial firepower. So if you have, for example, $1,000, you're able to trade with, for example, $30,000 or $50,000. It's added financial firepower, but that doesn't mean just because you have it, you should use it. I like the example I like to give is kind of like a credit card. Just because you have the credit card in the balance doesn't mean you need to max it out. Okay, just yes. Use it responsibly. Yes. It's designed financial firepower. Some people use it because they want to hedge, or long story short, you want to ideally you don't want to use more than 20% of the margin on your account when you're initiating a trade.
Okay. So I was mentioning that there are a lot of technical questions that I'll be touching upon, and of course it's going to be like a learning for me as well, because there's so many things that even I'm not aware of. So something we just call a position sizing. What does it mean?
The position, basically, you mean like a position size management or position management.
Okay.
Basically, you're managing your position in the sense that how much are you going to be using towards, how much are you allocating towards a certain trade. So you've identified your risk, you identified your reward above the market price. Now it's about how much you want to put in terms of size of your position. What position do you want to take? Do you want to go with a big contract? Do you want to go with a small contract?
Okay.
And this is where you have to look at it relative to the size of your account.
Okay. And like you said, you would suggest to put like 20% of your capital, right? Would you say that?
I meant of your account. The way it works with trading, especially with CFDs, is in order to open an account, you're using a certain amount of your. You're not paying for it. It's not a charge, but you are putting a certain amount as margin. So in that case, when you open up a contract, so for example, let's say you have a $10,000 account, I would not recommend opening something larger than $2,000 of value in terms once factoring in leverage.
Okay. All right. Perfect. Okay. So we, of course, you mentioned about the risk reward ratio, and can we discuss a little bit more about how to design it? You said the risk reward ratio needs to be 2:1.
2:1,
minimum 1:1, especially when you're starting out.
I'd say minimum 1:1, at least if you're starting out, because otherwise, if you make it too large, some people might say, "Oh well, I want to risk a very small amount." Actually, most of us, we go, "I don't want to risk anything at all. I'm going to go into it and I'm going to make money and that's it." We're never thinking about the loss factor.
But is that even possible? Can you?
It's very rare.
Really do that?
It's very rare to open a trade and it goes automatically in your favor. That's very rare. It happens sometimes, but it's very rare. And if you're trading on a daily basis, you can't assume it's going to happen. You have to remember how we said you have to factor in the worst. You don't want to think about it. You don't want to assume the worst, but you have to factor that in. So you have to say, okay, you know what? It could go right away in my favor. I could buy gold or I could buy silver or oil, and right away it goes in my favor. Great. But you know what? I have to bear in mind that there are going to be plenty of times where it won't, and I therefore need to set ahead of time what the risk is going to be and what the reward is going to be. And of course, you can, those things are built into the platform. You can automatically design that, but you just want to have that mentally ready and be mentally prepared, which is why it was so important that we started with psychology, to give you that idea that, okay, I'm psychologically ready to say, all right, this is how much I'm willing to make, and this is how much I'm willing to risk at most.
It's quite amazing because even after getting so much information and then, knowing that how much psychology plays a role, especially when you're trading or you're investing your money, and it is very natural, but easier said than done. It's never easy to kind of go ahead with it. I mean, I don't know what is it really. I mean, is it that you just don't have enough experience, you don't have enough knowledge, you don't know much about the trade, you're not adequately skilled? I don't know, but it seems just very, very difficult to kind of, put your hand into it.
Well, I would prefer, personally, I prefer someone be more on the cautious side instead of being very, very risk-taking and saying, oh, I'm going to be a millionaire, because that usually doesn't happen when it comes to trading if you're just going to start right off the bat. So it's good. It's not a bad thing to be cautious from a risk. It's not a bad thing to be risk averse.
But would you say that it's for everybody?
From a trading standpoint?
Yeah,
I think it's kind of like saying, okay, is business or even a type of food. I mean, is Thai food for everyone? Maybe it is, maybe it isn't. There might be some people that go, it doesn't work out.
It's more like,
So I think
if you want to do it,
I think, you give it a shot. You go in the sense that you can say, let me go ahead and research about it, see if it's the kind of thing for me. If not, then it's not. If it is, then it is. But I think a lot of times I understand if someone says I'm cautious before entering into anything. And that's not a bad mindset to have. Do your research, do your homework, see if it's right for you, and take it from there. And I don't believe in the idea that, oh, let's push it or let's be in a hurry. Not at all. Take your time, take a deep breath, sit back, do your research, figure out what's going on, and then take it from there. I think that's the sound approach when it comes to trading, and in fact to almost anything in life, actually.
Absolutely. And when you quantify it and you start putting numbers, it just becomes a little more easy.
It becomes easier to calculate. Now you can actually say, okay, this is how much I have, this is how much I risk to lose, this is how much I could make, not guaranteed to make, could make. This is how much I could make, this is how much I could lose, and this is how much I'm going to allocate from that capital. And of course, it sounds a bit, if you've never been into this before, it might sound like, oh, this is too much numbers, too many factors or stuff like that.
Absolutely.
But it's like anything in life. I mean, hey, look, it's definitely not going to be as complicated as, understanding how to open trades and close them is never going to be as complicated as, say, having a smartphone or something. I mean, you remember how complicated that was for the elderly. They're like, what is this? There's no way, or a remote, it's a TV remote, you don't know how to flip back through the channels and stuff. It's one of those things, but once you get the hang of it, then it's easier than it's easier than a TV remote. I promise, it's easier than that.
Perfect. All right. So Of course, we talked about when I asked you that is there any ideal percentage to define the risk, like how much, and you said that you would, of course, you would never go with all in, and you would just say,
you shouldn't have the all in mentality. But a lot of times, what happens is when someone allocates a small amount and then they start losing, they feel like they want to allocate more because they want to avoid losing, right? Nobody wants to lose, and it's not just trading; it happens even in business. Someone is losing in a business and goes, "Oh, let me allocate more to let me
kind of
invest
save
more
it,
to kind of save it." So a lot of times with trading, you really need to avoid that mentality in trading. You open a position, you've used up 20% of your capital. Don't tell yourself, "Oh, I've got 80% left. Let me go in and use all of that as well." That's not something you should be doing. What you should be doing is saying, "Okay, I'm going to allocate 20% and that's it. I've got my risk, I've got my reward, and I'm done. I'm not attaching myself to the direction."
And what happens if you start making money on it? Then do you think it's a good idea to kind of pump in more money?
Well, if you start making, first off, when you start making money, that's a good problem to have.
I
know people go.
It's like
It's kind of like saying.
Let me be a little greedy.
I wouldn't say greedy, but remember you have to remain calculated. So you have to have a calculated way of doing things. And a lot of times, when I talk to people that want to go into trading and all that, they've calculated. They haven't just calculated what they're going to do if they make money, like how they're going to change their trading. They've even calculated, what they're going to do with the money that they made, right? That's human. It's human nature. We start dreaming about it. You go, well, there's this mall I want to go to. This nice high-end shop. This fashion, this new item or something I want to go buy. So we already jump ahead. We leap ahead. It's part of our human nature. We want to daydream ahead to when we're at that level. Like I'm making this much, and this is what I'm going to buy. Okay, let's rewind it a bit. Let's step back. Let's come back to reality for a second. Okay. So I'm not worried so much about people preparing for when they make more money, about how, but of course you want to keep that into account. Like, okay, I'm making this much. If I start making more, maybe I will up the size, not the percentage. The percentage is still 20%. Okay. You can say, okay, I'll up the size because I'm now have more money. I can up it. So I was investing 20% or I was trading 20%. I'll still continue to trade 20%, but instead of $10,000, 20% of $15,000, now you're trading even more. So instead of 2,000, you're trading 3,000, for example, and so on and so forth. So it's fine for you to up the amount, but I would not recommend changing the percentage at all and getting greedy.
All right, perfect. All right, since we're talking about trading, investment, and how much to put into it and so on and so forth, do you think diversification helps?
Absolutely.
I think don't have to put everything
there's two aspects
one asset. Yeah.
If we're looking at it from an investing standpoint, then absolutely diversification is important. Do you remember how I said, like, if you put all your money into the car and then somebody dings your car, I mean, it's just you've emotionally attached. You put all your eggs in one basket. You're emotionally attached to that thing. Something happens to it. Your heart's going to drop. You'll be like, oh God, I can't breathe anymore. So, and same thing with a business. If you put it all into one. So ideally, you want to diversify because that does help. Well, first off, from a diversification point of view, it's good from a risk standpoint. You don't want to, because of the risk, you want to diversify your risks.
Absolutely.
But it's also about, from an emotional standpoint, even if you master not putting your emotions into your trade, it's good not to put everything into the trade because by default, you're going to invest, because you invested all your money into it, by default, you're going to invest all your emotions into it. And that's really a dangerous thing to do. So I would recommend diversification. I would recommend not putting everything into trading per se. So you trade a certain amount, you put a certain amount into trading, a certain amount, for example, if you want to go into investing or real estate or business, you diversify across the board. Within trading, you might say within trading, I would recommend actually that you focus on one or two products to trade. And the reason why is because when it comes to trading, you're in and out of a trade within the same day sometimes. So you don't want to focus on too many products at the same time. You want to spend a lot of screen time understanding how that market moves. How does it, when it reaches certain ranges, how does it react? Does it jump by 10 points? Does it fall by 20? And you want to massage that as you're working alongside it. So I would recommend sticking with one product when you're trading. But if you're saying about diversifying, don't put all of it into trading and don't put all of it into one.
Perfect. So you just keep your focus on one or two products that you're interested in.
That you're trading, that you're actually trading, and just trade that. So if you're, we mentioned share prices. If you trading a stock CFD, for example, Apple, for example, and you say, okay, I want to trade. I think it's going to go up, or I think it's going to go down. Because with a CFD, you can short, you can initiate a short and close it with a buy. So if a stock or gold or something is dropping in value, you are able to profit off of that drop by opening a sell and closing it with a buy, which I know is distant from what we see in the physical market because if you can only sell what you already own.
Yeah, absolutely. And it's very interesting because I was just discussing it with you off the actual camera, and you said something, and you said that in the physical world, of course, what you buy you can sell. But
you can only sell what you've already bought.
Exactly.
So someone goes, what do you mean you sold the market? I don't understand. So it means you bought at a lower price and then you sold it. So you're out of the market. No. I sold it as in you initiate a sell. You're able to sell something you're able to initiate a sell and close it with a buy as it drops. So if you think, for example, the stock market is going to retrace back down, if you think gold price is going to fall further, if you think, for example, Euro USD is going to drop, you can initiate a sell as it drops. You make money and you close it with a buy. But if it goes up, then of course you lose. It works opposite of a buy position. So that's something to keep in mind. But of course, like I said, that's why when you know your product very well, you'll know, okay, is it going up? Is it going down? And let me trade accordingly. And above all, I got to point out again, you have your stop loss, you limit your losses. I have to point that out because we're not built as human beings. So we have to remind ourselves to constantly limit our losses. Whereas when it comes to making money, we don't need to really remind ourselves because. Yes, it does. Because now you're actually quantifying it. Because some of you might be listening going, okay, I got to limit my losses, so I shouldn't lose everything. But then what ends up happening is if we don't quantify it, we end up losing a lot, or a lot more than we would make if it were to go in our favor. So we end up with these big losses and very small gains because we took profit too quickly. So one thing we want to do is we want to kind of balance it out. And this is why risk reward matters. 1-to-1 minimum. If you could ideally 2-to-1 and say, okay, this is how much I'll make if I'll make, for example, if it goes in my favor, $1,000. If it goes against $1,000, not more than that.
Perfect. Okay, so what strategies you would say we can apply, when the market is gaining versus when the market is falling?
Well, I think from a psychological standpoint, when the market is gaining, we have a tendency when it comes to investing, we have a tendency to want to hop on and buy. So if the market's going up and you hear people are like, oh, stock market's going up, you're like, oh, I want to hop on and I want to buy. So as an investor, you're always thinking, I want to go with the flow kind of. As a trader, because you're trying to trade ranges, there's a lot of range bound. By default, traders have a tendency to go opposite whichever direction it's going. It's not always right because there are times where markets are trending in one direction, they keep moving in one direction, and if you go opposite, you end up losing. So if you go opposite. Now, if you have a stop loss, if you limit your losses, that's great. For example, I'll give an example. You short or you sell an index, and the index goes up. Now you're losing. If you have a stop loss, if you limit your losses, you get out. Now you're out of the market. But if you hold on, what happens? You get squeezed all the way up. So you're holding on to this short, and it's losing and losing and losing. So as a trader, it's not wrong to say I want to go opposite market movement, but you do need to manage those risks involved. Whereas with an investor, it's more about buying and holding. So the strategies there, I'm not saying that then therefore the strategy as a trader is to go opposite. You could go in favor, what we call a breakout strategy. So if it reaches a certain level and it keeps going, you go with it. So you say, okay, if it's gonna, if Apple's price is gonna reach, for example, 400, I'm gonna buy it till 450. That's a breakout. You're going with it. Whereas if it goes up, if you think it's gonna come back down, you go on a fade or a reversal and you go, okay, I think it's gonna drop from 400 to 350, and so on and so forth.
Okay. Wow. All right. And since we're talking about again, taking all these risks and managing it and putting, limiting your risk with a stop, I want to know how often you should assess, your risks when you're especially trading.
Well, you obviously have to assess it at the very beginning, but then as you're trading, you can see the success or lack thereof when it comes to it. And then you should ideally have it after a periodic moment, like let's say after a month, for example. You want to give it some time. You don't want to just go in and you don't want to trade like once or twice and then say, oh, I'm losing. That's it. I need to change everything. No, that's not how it works. You got to have consistency and keep at it. But ideally you want to choose a period like, okay, I'll revisit this in 1 month's time, depending of course on what you can afford. Because if you lose for a certain amount, you want to factor that in. You're saying if I'm losing 5 times or 10 times, I need to factor that into my capital. So if you say, okay, I can't afford for a whole month, maybe 2 weeks, fine. After 2 weeks, revisit and say, okay, how have I done? It's always good, even at the end of the day, to look back and say, okay, how have I done? Did I trade according to what my expectations were? Was I disciplined, or was I actually breaking away from my discipline and over trading or holding on to losses too long and not trading my strategy? So it is a good idea to revisit it, maybe at the end of the day, to have your thoughts. Start of the day, remind yourself like, okay, this is what I need to do. This is how I need to trade. And then maybe after a week or 2 or even a month to go back and revisit everything as a whole and say, okay, how have I done for the month? Was it good? Was it great? Or was it dismal?
We discussed this even in a previous episode. There are a lot of people actually, especially who are starting out, a word of caution to them because, you tend to sometimes go too quick, like too often and too much, but you're saying that is not the way to move forward. I mean, you need to
take your time, that kind of sort of
Yeah.
thing. There's no point. You don't, why would you want to go into something you don't understand? I mean, we do provide a lot of educational resources to understanding it better. I mean, we hold seminars, things like that. But at the end of the day, you have to take it at your own pace, and you have to take a deep breath and understand it and study it to say, okay, this is something. This is how I want to go about it. And this is not just in trading, in anything really. You want to give it time, you want to understand. I always say that when it comes to anything you want to do, first thing you want to do, you want to understand the field you're about to get into. And even if it's a football match, you want to get onto the football match, you want to feel the field, you want to get to know the field that you're about to play on. It's not a game, trading isn't a game, but you need to understand the field you're about to get on. Second of all, you want to know the players that exist on that field, the ones that you're going to be, the counterparties, and those that you're going to be trading with or trading against. So you want to take a look at who those other people are. What are they doing? Are they buying? Are they selling? What are they trying to do? And we try to give that information, of course, to our clients to say, okay, this is where the big guys stand. They're selling this or they're buying that, just to give you an idea and say, okay, this is what other guys are doing. Could be right, could be wrong, but this is what they're doing. Third, once you have that in place, you have to understand, okay, how is this going to test my limits? And we've been through that already. We know how it's going to test us on the psychological level, and how do you overcome it? If it's football, you're going to be tested on your physique, but when it comes to on your physical strength. But when it comes to trading, you're going to be tested more on your psychology. Fourth, you then have to understand how to initiate trades, how to initiate those positions. And lastly, how to manage those in real time, because you're not just opening a position. You're not just buying an investment, for example, or buying a real estate and just leaving it. You're managing it in real time, and you need to know how to be able to do that. And the same thing with an open trading position. You're managing it in real time, and you need to understand how to control yourself and control your emotions while you're managing it in real time.
And one of the best ways to do that is actually quantifying everything, putting a number to everything.
Yeah, I mean, of course, once you do that, then because when you're managing it, you're saying, okay, it's very simple. You've got strategic thought process in place. You go, okay, if it goes in my favor, this is the amount, this is the amount. Yeah. You're putting X, Y, and Z to what would have just been psychological impulses. Yeah. You would have said, loss or win, but now
definitely more pragmatic approach. Yeah,
absolutely.
Yeah. Okay,
so necessary, not just pragmatic, but necessary as well.
Absolutely. Okay, so if we have to sum it up, and if you have to, just kind of give us 2, 3, 4 key pointers when it comes to risk management specifically, what will be those?
I'd say stick with especially if you're starting, stick with the risk. Yeah, obviously you have to measure your risk and your reward.
Yeah.
Risk, I say first, and the reason why is because we always know how to measure our reward. We always say, if it goes in my favor, I know what to do. Yeah. It's when it goes against us, you have to put an exact, specific figure in terms of risk, have an exact figure in terms of reward, stick to both aspects, have a ratio that's not greater than that's not less than 1 to 1. The greater, if it goes up to 1 to 2, that's fine. Manage your size, don't go all in. Don't over trade or over commit into it, and stay reasonable and keep it fun.
Thank you so much, Monte, for being on the show and sharing all the insights with us. I hope that we are a little more brave and less fearful, and we are able to tackle our emotions well when it comes to investing and trading. And also remember, you can't really control the direction of the market, but you can always tackle and manage those emotions and manage the risk that you're willing to take. So thank you so much for being on the show. All right, so if you're listening to us and you're listening to the second part of the show, what you have to do is log on to khaleejtimes.com and listen to the first part where we touched upon the psychology of investment, the psychology of trading, because it all starts from there. Also, what we've done is we have lined up a series of 10 episodes, possibly touching every single topic and everything that you want to know about financial planning. If you're listening to us on any other platform, log on to khaleejtime.com. You can navigate, you can listen to every possible thing that you want to know about financial planning. And you can also go to our social media pages. You can go to Facebook, Instagram, Twitter, YouTube. You can also listen and watch these episodes there. Also remember, this series is powered by IG. It's a platform where you can trade in over 16,000 financial products, which is quite exceptional. And also, do not forget to tune into our next episode where we will be picking up another topic regarding financial planning. The idea here is to educate you, empower you to create a more secure and happy financial future for yourself. And I hope that we are able to do it. Thank you so much for watching, and keep tuning into khaleejtime.com for more news and updates. Take care.